Okay, here we are.
Hi, this is Ron Granberg, and this is The Money Game. A little bit about myself. I am the owner of Clearwater Investment Management, a fee-only investment advisory located in Princeton. And I'm here with Rob Bell, the host.
Yep, I talked you into this.
And the owner of Green Birdie Video Productions. So I came up with the name The Money Game by looking on my bookshelf, and there's a book written in 1967 by a guy named Goodman called The Money Game, and it was a very clever, interesting, fun read on the euphoria of the 1960s stock market topping process. And the stock market topped in 1966. He wrote the book in 67, but it's very amusing reading that book in today's environment. So this program is about the stock market topping process here in the United States. And we could talk also about other world stock markets. They've already topped, believe it or not. Most of the European markets never even regained their 2000 highs, and they're already descending from their very early 2018 top. So, so much to talk about. But I do have an hour here, and if anybody feels like calling in, please pick up the phone and ask any question.
Okay, well, and they're going to need the number, which is 609-460-4673. That's the number to call. And I can put that on the screen later on. I just wanted to remind you that today is May 2nd, 2019. And the market has been on a tear to the upside. People are pouring money into the stock market, into Wall Street. All indications are that it's a very strong economy. Earnings are coming in right now, right, Ron?
Oh,
and
yeah,
they're very hot. They're good. Earnings are good for a lot of these companies.
Well, there's a game that's always gone on, or at least has gone on as long as I've been in this business, where estimates are made by the analysts that cover each one of the stocks, and those estimates actually get lowered into the earnings release. So
they get revised.
They get revised down. So to accomplish a beat, you get an earnings beat at the time that the number comes out, and that's everything is managed to work to enhance the sales process of the large firms. And of course, they make enormous amounts of money underwriting stocks and bonds at the top of the market. And that's the time when people want to, sell their company. That's when the private equity firms and and everybody else wants to IPO their company, sell it to the public, get the best buck they can for it at the top of the market, and have some other sucker hold the bag on the way down, because someone has to hold all these securities on the way down.
Well, that's why they tell you to ride the market, right? Like, even if it's going down, like today it's down to 220 roughly. 26,193. So it's down 236 right now at the moment. The Wall Street, the Dow, which is what everybody watches. You've pointed out in the past that the Dow really isn't a very accurate reflection of what's happening in the market.
Well, it's a very accurate reflection of the mood of investors, but it is only 30 stocks. And no matter how selective and how smart the people at Dow Jones are in selecting those 30, it's not really a great representation of the equity market broadly. But these are the beloved companies, and they get a lot of prestige for being in that index.
Is that a boost to the stock price, just being on the index?
Absolutely. There's so much money that tracks these major indices like S&P 500, the Dow Jones, the Dow Transports, Dow Utilities. There's a lot of prestige that comes along with being in that basket, and also people buy a basket of stocks based on those indices. So it makes things easier for these companies to raise money because they get they get that marketing done for them.
Now the S&P 500 is down 18, and the Nasdaq is down around 55. Yesterday, I think they were also down. I'm not sure what the Nasdaq did yesterday. I could look into it, but I think the Dow was down yesterday. But you know what really irritated me is that 75 Apple spent $75 billion on buybacks yesterday, and their stock jumped around 14 before leveling off around up 8 or 10 points. And that used to be illegal, right? I mean, up until 1982, stock buybacks were illegal because you're manipulating the market.
Yep, and I definitely think it's a manipulation. When companies, the buybacks that are going on right now are historic, and they are slightly larger than what went on in 2007, prior to that peak. But it still only amounts at the greatest, when buybacks are in full force right now, they only account for about 6% of transactions. So they still don't dominate the world of stock buying. There's plenty of other people buying and selling for other reasons, mostly herd related. And you could also even think of these corporations buying their own stocks back as participation in the much larger herd. And if you look at the history of all these buybacks, typically companies will buy their stock back at near or at the top, and they stop the buyback on the way down. Usually their CEOs get replaced as the companies need to move to much more defensive posturing, cut back their advertising, marketing budgets, lay non-critical employees off, and they stop their buybacks as well. A lot of the buybacks that are going on today are only enabled by very, very low interest rates and the willingness of lenders to provide them with financing. So that does come to an end.
So you and I have a difference of agreement because I think that stock buybacks it's significant.
Well, they are.
Factor in the. I mean, look what happened with Apple yesterday. I mean, it jumped like 14 points when $75 billion in buybacks is a lot of money.
Yeah, but a lot of times that just signals to other people that they want to hop on that train. So the buyback themselves, don't amount to the large, maybe the single largest buyer, but there's a whole bunch of other buying out there. In absence of that buying, the corporations could not support their stock.
Sure, but of course, wouldn't that stimulate buying? I mean, if you see the markets, jumping up on that stock, then you want to make money on it, or you're real happy that you bought it before it jumped up.
I've looked very closely at this. There's a buyback index. It's called the S&P 500 buyback. And you can actually take a look at that and compare that to the broader S&P 500 and see how these buybacks have affected the stock prices. And they are not keeping up with the rest of the market, which is an interesting thing. From time to time, they actually lag quite significantly, and it's it's not that they're not buying enough; it's that they are buying so much that plenty of other investors are scared that when those buybacks end, what is going to happen to that stock?
So it could be a negative, but Apple held on to its lead. Although I actually follow Apple. Yeah, it's still up. It's at 208 right now. It's still up around. I want to say at least 5-6 points, and in a down market because of that buyback. I'm just pointing out
Sure, no. But buyback is a loved company. There's always going to be
Apple,
a bid for that, what we are right now we are in a move that began on December 26th that's coming to what looks like it's fruition here, where the upward move, the velocity of the move up has sort of exhausted itself here, which basically means everybody that wants to get back in has gotten in. There's fewer and fewer people here coming into the market supporting prices and having those prices move further and further up. And given the cyclical nature of this very emotional market that we have, we probably have a down move, that's beginning here or hasn't, will begin shortly.
You're predicting a major down move, right? I mean, you have been for quite a while now, actually. Kind of a doomsday prophet.
Absolutely. The bull market that began in March of 2009, March 9th of 2009. So we're 10 years into this. This is one of the longest bull markets ever, and this one was artificially supported for a very long period of time with low interest rates from all the world's central banks who've sort of conspired together. Talk about collusion. I mean, that's definitely collusion to provide for anybody who wants any borrowed money can now borrow it, and a lot of it went into financial assets, sending those assets higher, much higher than is prudent for anybody to own these things at these levels.
Mm-hmm, mm-hmm. Now, another significant thing that happened was the Fed said that they were not going to raise or lower interest rates. And the market didn't like that because I think the market wants them to lower interest rates. They're pretty low already.
Yeah.
But they want to lower them some more, right?
Yeah, these are crack-addicted investors. They want, an assurance from the government because they think the Federal Reserve can save the day from any, stock market collapse, air pocket plunges. And history says that they can't. I mean, they cut rates, before the top of the market in 2007, cut all the way down, and the market just fell. Irrespective. Once the speculative urge falls away, there's nothing to support the stock prices at these levels. And right now, all the financial news networks, the tone coming out of the central bank in the United States or everywhere else is very calculated not to disturb, the confidence in that investors have in that these market prices will stay around these levels. That it's very important not only for the financial markets themselves, but the signal that they send to the economy more generally is devastating. A fall in the stock market turns everyone's sentiment negative. In fact, if you look at any of the forward-looking forecasts coming out, whether from rating agencies on default rates or on Wall Street, what the single most important component to forecasting what goes on in the financial markets is stock prices themselves. You don't get most people don't get a chance to look at how these forecasts are built and what are the most significant components of it. But stock prices themselves are that key component, and it's an endogenous process. Stocks going higher creates a persistency for them to go higher.
You've said many times that human beings are very optimistic.
Yes.
In general, and they don't like to, they don't want to sell. They want the market to grow, right? They want to buy into the market. This could be considered a buying opportunity. The fact that it's down, 220 right now.
Oh, there's a conditioning that goes on that everybody goes through from the beginning of the bull market. In this case, it's March 9th, 2009. Where the market goes up and it dips quite substantially, and then it goes up more and it dips another substantial dip, but it's shallower than the last time. And through many iterations, those dips become shallower and shallower until the peak happens. And then the reverse happens. You get sometimes sometimes you get an explosion to downward movements like 1929, 1987, 1989 in the Japanese stock market. But other times you have hope dissipates very slowly. I tell all my clients, and in this topping process, hope has a longevity that it's not unique in the course of history, but it's very similar to what went on in 2000 in that topping process, where there was 3 tops that spanned over late 1999 into late 2000, where the S&P 500, I believe the Dow also peaked up 3 separate times before the bear market really grabbed some traction and stocks started falling. All during that time, there was a whole host of signals saying that this thing was coming to an end. Those are largely ignored. They are ignored on television because of who's advertising there. The large financial firms are advertising to a very large base of potential and existing clients, and they certainly don't want to spook any of those people. And they also want to keep that bull market alive as long as possible, because there's always in wait a company that wants to sell itself, an owner that wants to get out and retire, and he wants peak valuation. He doesn't want to sell it, mid-cycle. He wants the top dollar for it and hand it off to some sucker who's then going to experience the plunge in valuation. And that's where we are right now. It's easy to control a crowd. I mean, just look at Donald Trump and how he controls his crowd of that 38% that love him to death. The financial news channels have their, they got their following, and those are the people sitting on their couch who call up their brokers and buy stocks as they listen to these salespeople they have titles like, chief equity strategist, but you should know that these are salespeople. They're doing a song and pony dance, selling whatever. I mean, Lyft was a couple weeks ago, Uber sometime in the future. This is where they make their hay. At the top of the cycles, everyone wants to go public, and they get a huge cut. And we're talking like somewhere between 4 and 6% on a company like Google selling for $120 billion. We're talking serious billions to the underwriters, and they're not going to spoil that by having honest conversation on their television channels, on the media channels, where they spend a lot of advertising dollars.
Exactly. I agree with you. Although I do watch those programs, and it's pretty easy to get caught up in the in the excitement that they show.
Sure, it's like watching a football game.
Yeah, and you feel dumb because the market does keep going up, for whatever reason, against all reasonable odds, right? So
there's always the final cohort that comes in, and right now the final cohort that's coming in is households. They're putting their money in. So they probably in most bull markets, the ordinary Americans, they come to the party very late. They wait for this thing to go up for quite a while because they have the memory of the last catastrophe. So they join very late, and some of them actually, they put all their money in right at the top. It's a sad thing, and also here at the top is the top because that's when the most participants are here. So that's where most of the margin debt is generated and created. A lot of borrowed money going in. It used to be once the New York Stock Exchange margin debt exceeded 2.5% of of GDP, a crash was assured. We passed that level about a year and a half ago, or 2 years ago, and I think we're at 235 now. A lot of margin, a lot of borrowed money in the financial markets.
I apologize because I just put a graphic. I'm playing with the graphics a little bit on the screen, but I want people to realize, what's happening now, because when they watch the show later on, they have a reference. So, you have no idea what I'm talking about right now. But we are simulcasting on PANJ TV. So if you want to watch the video version, you can watch that now, and you can check that out. It'll be up there. You can check it anytime. So Ron. Are you a little frustrated as a bear? You've been telling me for a couple of years now that the market is going to crash, and yet it keeps going up. And, people who are making money on this think you're nuts at this point.
Well, the market hit its peak on January 26, 2018. So that's about 15 months ago. That will be marked by the historians as the top of the market, and that's the top of the cycle for the European stock exchanges. Well, the rest of the world peaked on January 26th. The sentiment readings, everything peaked. Everything hit extremes, like broke through extreme readings on so many different oscillators. And sentiment readings. So the bullishness is actually somewhat abated, but we are also now at the third peak. The third peak in 15 months. This will reverse to the downside. I think this will be what people will think of as the kickoff to the new bear market.
No, did we go in and out of a bear market already? Or
No,
are we
no,
in
no.
one, or are we waiting for one? What's our status?
Well, we're in a bear market. January 26, 2018, the Dow and S&P put in top levels. On October 3rd and September 21st, they exceeded that by, I think, 0.57%, basically a hair. And then after coming on, then we had that plunge through December 26th, and then this last ramp up here is just about to put in a high that will be the third one, although it hasn't hit the September 21, October 3rd highs. And when I say October 21, October 3rd, I'm talking about the highs were separate or different dates for the S&P and the Dow. And these last highs here, these are the product of technology stocks, and the optimism that surrounds all these technology companies is what's producing the second and the third top here, just like it did in 2000. Hope dissipates slowly. So Apple, as you were mentioning before, is popping back up. That the belief that these companies could generate for shareholders additional wealth, that's not going to be, that mindset's not going to be challenged until, for most people, for the herd, for the crowd, until the stock market does actually do breaks to the downside, and then that will shatter the resilience of that hope. And that will happen. I mean, it always does. I mean, prices do not grow to the up into the sky. There's no magic beans, no beans, stalk. And this is normal, and it's healthy. God forbid we didn't have a bear market. The bear market clears away all the debris that's built up during the expansion, all the reckless lending, all the stupid companies that hired an enormous amount of people, and they're the products are just it's not adding anything to society, and eventually all these what seem to be ingenious and innovative things that are put in place at the end of the cycle, they become just novelties later. In history, looks back and says, "Oh, that was nice," and they forget how many investors lost the bundle on it.
What I mean, what it used to be, the value of a stock was based on what the multiples of its, I mean, it doesn't seem like the numbers reflect what's happening with these stocks. I remember when we had the dot-com bubble, and they were, the earnings.
Right.
They were saying that these companies were like trading at 23,000 times earnings. I mean, is that still a valid measure, or are all these stocks basically out, just on the moon, and there's just complete disassociation from reality at this point?
There was a time many years ago, probably before I entered this business, back in the, I guess in the 80s, early 90s, where corporate finance didn't get sophisticated enough to like manipulate their earnings. So most people will look at that earning number that comes in, that calendar year number, earning number, and put that in the denominator and say the price over that earnings number represents how cheap or how expensive. That you can't really do. That doesn't make any sense anymore today, given the manipulation of one expenses. What sometimes they take an expense, and rather than feed it through a profit and loss or the income statement, they capitalize it and say, oh, we spent $100 million here, but this is really an enhancement to the business, so we'll put $100 million on our balance sheet, and we'll amortize that over time as we use up that asset. That's one way to take ordinary expenses and fraudulently and move that over to the balance sheet, and increase your earnings. And those tricks go on at the end of the cycle, because these companies are under enormous pressure to make their earnings, and their earnings are so important to them because they're going to get payouts to the tune of tens of millions of dollars if they meet their, these targets that are set by the board of directors.
Yeah, if you don't hit a good target every quarter, you're fired, right? And they put someone else who can do that.
Well, they'll get rid of everybody in the down move, because then they need to create another myth, another narrative for their story. So, oh yeah, we cleaned ourselves up, and now we have a new leader. But the earnings numbers, that's an important, that's a sleight of hand that's done on television all the time. They talk about how this company is cheap and how it's going to grow its earnings all the time. That's just not, at end of cycle, earnings go down. The earnings and profit margins are the most cyclical aspect of finance that exists. Saying that their earnings will not fall into the future and their margins are not going to contract is just ahistorical. But
well, the market is forward-looking, right? That's what they always say.
Yeah.
So the fact that the market is so stable, I mean, now it's recovering. I mean, now it's only down. It's down to minus 217. But it seems like it hits a plateau every day, and then it kind of sticks to it. Yesterday was an exception. Yesterday it was up most of the day, and then it crashed at the end of the day, down to 160. But in general, we're not getting the wild fluctuations that you would expect to get from.
We'll get them
from a bad market, from a bear market.
Oh yeah, we do. We've got it. We got a February 2 to February 9 plunge off of the January 26 top. That was a 12% drop in half the number of days. That's impulsive. If anything should tell you that we're in a bear market, that was the kickoff to it. Because, and then following the late September, early October second top, we had another abrupt drop, which then finished up into the December 26 plunge, where our wonderful,
things looked really bleak December 26th.
Yeah.
How did they recover? I mean, go ahead.
You had Mnuchin, our Secretary of Treasury, come out and say that, coming out with some, which I felt seemed to me like the weirdest statement on Christmas. Was it Christmas Day or Christmas Eve, or was the Sunday before? that all the margin desks are not having a problem, and it was just an eerie statement. Like, if I was in that job, I certainly wouldn't have tried to throw any fuel on that fire, but it's exactly what he did. That market turned around, and
It did. So, it's I'm not trying to play devil's advocate here, but a lot of people would be, hey, you just buy and hold. It comes back. You always make money in the market.
And that's exactly what you're told on the financial news networks, whether it's Bloomberg, CNBC, you name it. They want you to hold. But the fact of the matter is, you have a ramp like we had from December 26 until now. Those have occurred those are bear market rallies. This is a very strong one, but then again, we are at the largest top in the U.S. market. We are at the highest valuation point that the U.S. market has ever experienced. And valuation is something that, this is something that has math behind it. It's truth. It's objective. This is not the subjective nonsense you hear on television. The prior instances of valuations at this extreme were 1929 and 2000. Those are the two principal wildly overvalued markets, and we're more overvalued than each of those instances. And
when you say overvalued, I mean, how do you measure that?
Oh, okay. There's a number of ways to do it, but the best way to look at valuation is to see subsequent returns from those valuation peaks. So if you have a statistic that will, that over history has said, it showed you that, this was the most expensive market, and the subsequent crash and fall in market was, in fact, the largest ever, then that statistic actually is an accurate measurement of overvaluation. And in this case, what you want to do is take, and I'm going to make this very simple for the audience here. There's a number of ways to slightly improve the correlation coefficient and the explanatory information on this. But if you take, for simplicity speaking, if you take the market value of U.S. stocks and divide it by the GDP of this country, and then you look at that at all points in time in the past, the absurd peaks that occur are 29, 2000, and today. And using a tweaked model that includes for transfer payments and foreign trade, you can create a very high fitting model for valuation, explaining about 92% of subsequent variation in stock prices. So that probably for the layman comes across as very complicated, but
yeah, definitely.
but think about it. Imagine that you have you're willing to pay for a set of cash flows in the future. So say Rob, I was going to give you $100, and I was going to give it to you 10 years in the future. If you pay a certain amount. Now, if you pay $50 for it, you're getting $50 a return in the next 10 years, and you can create a yield on that. What investors today don't understand is that they're not paying $50, they're not paying $60, not paying $95 for that $100 10 years from now, but they're paying somewhere like $102, $103, $104 to receive $100 in the future. And
that doesn't sound like a good investment to me.
No, it isn't. And it's one of the pieces that they're missing is the fact that earnings don't grow to the sky. At some point, investors think that 1, 2, 3 in that sequence, the next number is going to be 4. But somewhere in that sequence, the next number is not going to be the next higher number. It's going to be a step down. So rather than 4, the next number could be 2, you know? And that's how financial markets work. And they move very, very fast. And the crowd who have been brought up on an intellectual diet of, you know, Jim Cramer and Susie Orman, as well as the other nonsense on financial news, they have no sense that that change is going to happen, or that it could happen, because they're led by a whole bunch of happy talk and optimism on television, and that's where all the financial literacy of Americans come from, television.
Oh, absolutely.
And I have no problem with that format. I mean, you know, it just makes it easier for me to achieve better results for my clients, given that everybody else is getting terrible information.
I have the call-in number on the screen now. I'm not actually expecting any calls today because this is a brand new show, and we need to get the word out on it. But in case you're watching or listening and you'd like to call in, it's on the screen. It's 609-460-4673, and you can talk to Ron right now. We'll be on the air until 1 p.m., and the show is going to be on every other week. So we'll be reflecting what's happening in the market. And, you know, in a couple of weeks, could be very different numbers on the screen as far as what's happening with the Dow Jones and the S&P 500, et cetera. Right? So.
Yeah, it's going to be this is going to be fun for people who are prepared. It's not going to be very fun for everybody else who's expecting a new blossoming of economic prosperity from these levels.
Well, if you listen to the administration, you would certainly think that that is the case.
Yeah, they are, you know, they definitely want to keep hope alive. And as a strategic, you know, something that, you know, Donald Trump and his team is doing, it makes a lot of sense. Keeping the confidence high, keeping it as high as possible for as long as he's in office is what they want to do. You would not, unless Donald Trump completely loses his mind, he will always be talking optimism here, even as it goes down.
It's his Trump card, no pun intended.
Yep. Herbert Hoover, you know, he spoke he understood too that optimism is very important for, you know, keeping those entrepreneurs and business managers hiring additional people, spending their money, expanding plant and equipment and everything else that they do. That's what keeps the economy going. And when optimism fades, so does the stock market. In fact, it becomes a you know, it's an endogenous process. So you first see it in the fall in the stock prices, and then additional people will move towards pessimism. And Donald, you know, it's in my estimation, and I don't think I'm wrong here. You know, his success as a president is going to be over with the stock market.
Yeah, pretty much. I mean, his administration's up against the wall right now with today. If you might recall, if you're watching this later, this is when the Attorney General Barr refused to go to speak to the House. He spoke to the Senate yesterday, which was kind of a friendly arena for him, although he did get hammered by a few of the Senate Democrats. But today, with all of those House Democrats, and then they wanted to have an attorney, similar to when Kavanaugh was in front of the House, the Republicans had an attorney asking his accuser questions. But now, when the shoe's on the other foot, they refuse to have an attorney asking Attorney General Barr questions. So he refused to appear in front of the House today. And I would assume that within the next couple of days, there's going to be a subpoena. And if he doesn't respond to the subpoena, then I think he could be arrested. But that doesn't seem to affect the market at all. And I've complained this to you many times about this, Ron, that, you know what I mean, this entire time that Trump has been with his shenanigans and lying to the public and running up the deficit, you know, giving a tax cut at exactly the wrong time, you know, when the economy is doing well. It's not when you want to give
Yeah, he
a
actually.
tax cut and run up the deficit. So it doesn't seem like what he's doing is good for the economy, and yet the economy is rolling along regardless of what this guy does.
Well, he did a number of things that I think history is not going to be very kind to him. One, the tax cut was for the wealthy, and you, as a politician, you don't do that. You do that in your third year, right when you start, the campaign, and the impact from his tax cut is already withered and it's gone. It's behind us. It's in the rearview mirror. So whatever, maybe he did that to sort of buoy his, his status among his base because of this, the whole Russia thing.
He's a man of the people.
Yeah, and but what was the other point? You made another good point. I wanted to make a comment.
He ran up the deficit.
Oh yeah,
I mean he's
the unintended consequence.
The irony of Republicans, they always get in and they run up the deficit. Democrats come in and they balance the budget, and yet the everybody feels that it's the opposite. That there's the Democrats that spend money. It's crazy.
No, what he's done is reckless. We had a downturn from the great financial crisis, and that was never able to run its course. The federal government threw in a whole bunch of backstops, to buoy the car industry, the financial service industry, enormous amounts of bailouts. If we wanted to have a healthy economy today, we would have needed all those companies to go bust and go through a bankruptcy process, and to have new capital brought in and new owners. That didn't happen. Not only did the special interests get the bailouts that they wanted, but then they got their fingers and pencils in the whole Frank Dodd bill. So they neutered what they could on that. So we're set for a repeat. And we have...
and there's going to be no recourse because in 2007-8, they could lower rates, right? I mean, but now they can't do that.
Lowering
the rates are low already.
Lowering the rates, there's what they say, there's no ammunition. They'll cut it a few points. But regardless, that's no panacea for a financial market rout or a bear market. The bear market is basically a movement off of peak optimism into pessimism, and you can't stop that. You might be able to slow it a little bit by lying on television, telling everybody repeatedly that everything's great. But at the end of the day, there are cash flows that need to be paid. There are going to be bond issues and loan issues that are going to be heading towards delinquency, default, and you can't hide that stuff. So at the end, everything that's done to conceal the fragile nature of this financial system that's overly financialized and has been given access to credit at incredibly low rates. This is the final move. This is it. You lower rates down. You got 10 trillion of negative yielding sovereign bonds, and we still don't have a vibrant economy. We still have job participation rates down at 40-year level.
We do have very low unemployment, but they're shit jobs.
Yeah,
if you don't mind my French.
Yeah, that low unemployment rate, and thanks for bringing that up, Rob. That's the hallmark of the top of the cycle. The top of the cycle occurs when that rate hits its bottom, and once it starts lifting off from there, you're in a bear market, and also that's a very lagging indicator. So that number is going to be rising, but not in the beginning of the bear market. Prices descend first, later, then all the job searches slow to a halt, and the last people that were selected
because
for
people
employment,
are in despair, they don't look anymore.
No, companies just.
Right, there's a lot of layoffs. I remember, I was working in 2007 and they laid off tons of people. I was working at Fox News.
Yeah.
They didn't lay me off because I'd been there for many years, but anybody who had been there for less than 13 years, you'd think you'd work in someplace for 13 years.
Right.
You might have a little job security. Nope. That's it. 2 weeks notice. Boom. Out.
Yeah.
So that hasn't happened yet though, Ron. And that was happening, that preceded the last huge drop by at least 6 months to a year.
No, it didn't. The layoffs, they came after.
Yes.
The top of the market the last time was October of 2007, and the layoffs didn't happen, or you weren't notified of layoffs until early 2008. I think
Exactly. That was the time frame.
yeah.
Yeah, but I mean, everybody was still very optimistic about the market.
They-
When they started laying off, they were looking ahead and they were going, you know what, this doesn't look good.
Yeah.
We got to get rid of some people. You know, we got to fire people.
Well, the first thing that's done usually is they put a hiring freeze on. So then they want to have to, then they deal with, they want to have attrition lower their, their labor expense. So the attrition and then they start getting rid of employees when things get really serious. That's not, I don't think that's very far away in the future right now.
And there's such wage stagnation. I saw somewhere that if the average worker was paid the same as CEOs, that the minimum wage would be $33 an hour right now.
Yeah, that's an awful thing that's going on. What we've experienced in the last couple of years, really in the last, it's accelerated in the last 10 years, is centralization of everything. The government is centralizing everything. And corporations are merging, becoming larger and larger. And they not only do they get, and it's not so much that they get, any, efficiency gains from the scale that they have. They get a lot of power over labor. So you have fewer and fewer, larger and larger employers, and they're doing that in that way that they can really, control what employees are being paid. It's an awful thing. I actually think that these corporations have gotten so large that in the next downturn they're going to have to be broken apart. They're going to be broken apart themselves as they sell off divisions to be able to get the debt levels under control. That's usually what happens. I mean, through the 60s, you had a bunch of conglomerates, grow to enormous sizes, and then in the late 60s and 70s, a lot of those companies broke themselves up again. It's an ongoing process.
Well, it's a great way to make money for the corporation if you have increasing productivity from your workers, which I think we've had record productivity.
No, you're wrong on that.
But you don't pay them.
No, we've actually had very bad productivity.
Oh, okay. Because now that's probably another thing that I got from CNBC.
But that is productivity is not something that is goes along with centralization. Corporations have taken their entire workforce and they've created silos. So minimizing the value, the future value of each individual employee by putting him in a silo, limiting his responsibility to what's directly in front of him, and he doesn't see what's going on in the rest of the corporation. That has really created first of all, awful work environments for people, because things get very, very boring when you're only focused on a very small segment of what's going on. And when you have fewer and fewer employers hiring these people, it's easy for them to control, what's going on. They don't actually have to conspire by talking together, but they you don't, except for the C-suite, everybody else's income has been
It's been
managed.
stagnant.
Yeah, and managed downward.
Right. And it's confusing to me because it seems to me that all you have to do is give people a raise and they'll turn around and they'll buy stuff, and that's good for the economy.
Yeah, but
Instead of giving tax cuts to the very extreme wealthy, because what do they buy? Well, they might buy a $5 million jet,
right.
or maybe they'll buy another $5 million house, or they'll put the money into the stock market. But they don't put the money. They don't go out and buy a washing machine.
Right.
You know, and the bottom line is our economy relies on people buying washing machines.
You know what? And this is, John Maynard Keynes wrote a wonderful book back in the 30s, General Theory on Money, Interest, and Employment, or something along those. I always get the last three confused. One chapter was on the propensity to spend, and the rich don't have the same propensity to spend. Their marginal increased incremental dollar, like the middle class and lower class. And when the upper class accumulate too much of the wealth, too much of the income, economies fail. That's that's what happened in the late 1920s, where prosperity wasn't widely brought to Americans. And to the Europeans, and that sows the seed of discontent. Back in the 30s, that created an environment for Mussolini, Franco in Spain, and of course Hitler in Germany. And the discontent prior to that, from World War I produces the Russian Revolution. So. You can't let, from a sort of society's perspective, you can't let inequality get too friggin' bad, and they're letting that get bad. There's no effort being made to nip that in the bud. I mean, that's our capitalist system, but we have a self-correcting mechanism for that, and it's called a bear market, and that levels the playing field, and it also creates and if the bear market is bad enough and the government doesn't bail out a particular constituency, that's a leveling. That levels the playing field again. Makes the rich a lot poorer.
So what do you recommend that people do if they don't want to watch their savings disappear in the coming crash? What should people do? I mean, they have to do something with their money. If you put it in the bank, you get what, 1.1% interest? Doesn't even keep up with the rate of inflation.
Well, what most people I believe are incapable of making these decisions themselves. And I know that sounds, in a world where you can do all your trading from your computer at home and it's so easy, you don't want to end up as the bag man holding the stocks as they plunge or any other security. And there's a whole host of toxic securities in this environment today, reminiscent of what existed prior to, during the subprime problem and prior to the great financial collapse. Subprime doesn't exist in the mortgage space to the extent that it did before. You need a collapse to make that obvious, and there's precautions put in place for that. But the financing has just moved somewhere else. Today it's in the leveraged loan space, it's in the junk bond space, and there's a whole host of like aggregated vehicles, whether they're mutual funds, ETFs, that are sold to individuals and retirees, people with 401k money, and they're presented as a solution that usually the thing that didn't blow up the last time becomes the solution this time. So, leveraged loans, believe it or not, did not blow up the last time. So now that simple statement, they didn't blow up last time, is enough for a salesperson to make a sale. And it just so happens back, in the last cycle, that's where the mischief wasn't in that space. Today it is. Every
Right.
corporation that wants to borrow money to buy back their own stock or acquire another company, or owners want to take their money out, or they've raised their money in the leveraged loan market. And and there's enough similarity and standardization for each one of those loan documents that it could be purchased by someone who has a leveraged loan fund, and he buys it, and a bunch of retirees, people not knowing better, or usually their financial advisor who has no sophistication whatsoever will put their clients in that stuff. And it was an easy sell because there was a point where rates started rising, and that was also made an easier sell. When rates rise and the Fed moves rates up, you're going to make slightly more. But that's where a whole host of toxic loans exist. And these are loans for companies that don't have the staying power to continue to make these quarterly loan payments.
So are you saying that there's no safe haven? Like
Well,
everything is going to crash. Properties are going to lose value. Gold is gold a good place to put money? Where can you not lose your shirt when this thing crashes?
Well, you have to be nimble, and it's very dynamic. And the word dynamic means things are going to change, and they're going to change repeatedly, and they're going to change unexpected for most people. And changes create other consequences. So, it's not simple to say that prices are going to go from A to B, because there's going to be a very jagged movement towards B. And there might be a hiatus of sideways movement that happens over many month period, and then there's a head fake in the other direction, and then it completes and moves that way. So the dynamism makes it almost impossible for someone who doesn't understand the real technical aspects of how prices move, and how those prices, as they move, provide information to someone who, is looking for where this move is going to go to. Where could you? So what could?
And only have a couple of minutes left here, Rob, but we're going to be on again in a couple of weeks.
Yeah. So why don't we wrap it up there? I'm going to finish that statement in my next episode.
Okay. Well, thanks for taking the plunge, having a show on PANJ Radio with the simulcast on PANJ TV, and we're going to get some more people to call in and more people to listen. So I hope you're on our airwaves for many years.
Mm-hmm. Thank you for having me.
Of course. And we'll see you soon. Thanks for listening out there.